Let's understand the difference between EBITDA and net profit. Imagine the situation where a business has made an annual sales of 100 crore and they have incurred following operational expenses. That is raw material, labor, other manufacturing expenses and depreciation. Then let us also factor other expenses like selling, general, admin expenses and interest expenses. So if you deduct all these expenses from the sales, you will get profit before tax. Let us deduct tax also, you will get profit after tax. So this is basically P&L of an entity. Let me just rearrange them. So what I have done here is I have shifted this selling, general, admin expenses to this group of expenses. So here you can see raw material, labor, other manufacturing expenses, selling, general, admin expenses. So if I deduct all these expenses from sales, what I get is EBITDA. This is the earnings before depreciation, taxes, amortization, interest as well. It means from this profit of 29 crore only, we are going to provide for depreciation, we are going to provide for interest, we are going to provide for taxes. Whereas this profit and loss statement has just given us profit before tax. From that we have paid taxes and we have profit after tax. So now comes the steep comparison between the EBITDA and net profit, that is earnings after tax. This earnings after tax is the earnings for the owners. This is the profit which is arrived after deducting all the expenses. So it communicates the overall profitability of the business. If you can compare this with sales, you will get the profit margin. If you can compare this profit with the money invested by the owners, you get the return on equity. So this is the ultimate performance measurement indicator. Whereas EBITDA, which stands for earnings or profit before interest, taxes, depreciation, amortization, in short we say non-cash items, is the profit that is actually going to contribute to depreciation, interest and taxes. And why this is important? It's important because this interest is the reward for the lenders, tax is the reward for the government, and earnings after tax is the reward for the owners of the company. So it is this profit which is going to contribute to various stakeholders. We can say EBITDA only contributes for recovering all this cost. If you compare the EBITDA with sales, what you get is EBITDA margin. And if you compare the EBITDA with total capital employed, that is equity plus liabilities, you get what is known as return on capital employed, which is very important key indicator, key financial indicator. It communicates what is the return generated by this entity by using all this capital. Only when this is satisfactory, only when return on capital employed is satisfactory, we can expect some decent return on equity as well for the owners. And here we go, Credit and Financial Analysis Mastery course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1 year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.